Still concerned about going concern? This is the IssuesWatch podcast. Hello, and welcome to the IssuesWatch podcast. I'm Brad Muniz, your host for the bi-weekly accounting and auditing episodes. I'm an assurance principal at Clifton Larson Allen. Quick disclaimer, the views and statements expressed herein are my own and not necessarily those of NJCPA or CLA. Okay, you've heard me and Frank and talk about going concern many times. In fact, I think one of our previous episodes was on, we talked about going concern. But it still seems to be an issue, so I want to give a lot more time, the whole episode, towards going concern. Which also means there's not a lot of stuff that's come out lately, so we generally try and pick on a topic and cover that in the particular episode. So going concern. Let's talk about some quick history. SAS 34, the auditor's consideration when questions arise about entities going concern. SAS 59, auditor's consideration of an entity's ability to continue as a going concern. SAS 126, the auditor's consideration of an entity's ability to continue as a going concern. Catch a theme in those? Order. Then ASU 2014-15, presentation of financial statements going concern. Now, ASU is accounting standards update. SAS is a statement on auditing standards. The ASU, again, are accounting standards updates. So now this has been folded in to the accounting lexicon, not just the auditing area. Why? Because the FASB said going concern, which we'll talk about what that is, going concern is a financial statement assertion of management. It is not a responsibility necessarily of the auditor. It is management's responsibility. Now, I'm older. In fact, I graduated college when SAS 59 came out, and we were used to it always being just the auditor's consideration. Well, back in 2014, they said, no, this is management's consideration. They have to be making the assessment. We'll talk all about that in a couple minutes. What is going concern? Much like a qualified or unqualified opinion, going concern is probably one of the worst wording that they could use. Because anybody hears going concern, what do you immediately think? I'm concerned about it going on. I don't know how nobody ever thought about that when they came out with it, but going concern actually is good. If your business is a going concern, that is good. It's when you have issues or substantial doubt about going concern that it becomes bad. But let's just dive a little bit deeper. What is going concern? The going concern assumption is a basic underlying assumption of accounting. For a company to be a going concern, it must be able to continue operations long enough to carry out its commitments, obligations, objectives, and so on. In other words, the company will not have to liquidate or be forced out of business. If there is an uncertainty about a company's ability to meet the going concern assumption, the facts, and conditions must be disclosed in the financial statements. Okay? So if there are issues, you have to disclose it. We're going to get to a lot of this, okay? What is required now? Management is required to evaluate for each annual and interim reporting period whether it's probable that the entity will not be able to meet its obligations as they become due. Okay? Management is responsible to evaluate the situation in each annual and interim reporting period. When obligations become due, here's one of the other big changes that they made. Within 1 year after the issuance of the financial statements. It used to be 1 year from the balance sheet date. Now it's 1 year from the issuance or available to be issued issuance of the financial statements. That's the big change. That this is management's responsibility to assess it. When management identifies substantial doubt about the entity's ability to continue as a going concern, management should consider whether its plans to mitigate the conditions will alleviate the substantial doubt. So here's the problem that I see. First, management is not doing this evaluation. It always comes up that the auditor or the accountant doing a review or a comp picks up on it and that has to discuss this with management, and it gets very contentious. Okay? Also, there's always that lack of, okay, it has to be 1 year through the issuance of financial statements. So if you hold financial statements till December 31st or December 30th of this year of 2024, you say, oh, well, they're going to make one more day. No, they have to make it till December 30th of 2025. Substantial doubt is about an entity's ability to continue as a going concern exists when conditions or events considered in the aggregate. That's one of the big things too. Just because you have one item, depending on how significant it is, but you have to consider it in the aggregate. Indicate that it's possible that the entity will be unable to meet its obligations. So let's talk about certain conditions. The first one is very easy. Negative financial trends. So I always say, I do a lot of second review, or I've done a lot of EQR in the past. There are 4 things that I look at in a financial when I open it, just as obvious indicators of going concern. 4 easy items. So ready? Stop the episode, get your pen. Okay, go now. Okay, negative working capital. Current assets less current liabilities. Negative working capital. Accumulated deficit or negative equity, either one. That one's a little bit looser, but okay. You see where I'm going with this. Recurring losses, or how significant a current year loss is, recurring losses, and negative cash flow from operations. Those are 4 things. I just open up the basic financial statements. I look, I go, negative working capital. That doesn't look good. Now, what happened was last year, when everybody adopted the 842, the leases, it put the right of use asset and the right of use liability on the books. The problem is you have a current portion of the right of use liability, and all of a sudden the right of use asset is in the non-current section. So that created a little bit of a situation. Negative equity. That could be from previous losses from the 1980s, 1990s. Who knows when it came up? That does happen. Also, there could have been that there was a significant buyback of treasury stock. So that was a little bit looser, but I do look at that as an indicator. All right? Recurring losses, or how significant the current loss is, that's another one too. And then negative cash flow from operations. That's the big one. Because as I think Paula Young, when she was here, talked about how important the statement of cash flow was. You look at cash flow from operations, that's what people are looking at to see how are you able to support your operations just from standard cash flow. Then you have investing and financing activity. But those are the 4 areas. Then you go look at the footnotes and you look to see about, did they fail their covenants? Do they have agreements with customers that are going to end soon? There's a lot more information. But they gave 4 general bullets. Negative financial trends, under indicators of possible financial difficulties, for example, default on loans. Internal matters such as work stoppage. If you have a union and it's significant and they're threatening to strike or something, now usually it doesn't put the company out of business, but can it? You have to consider it. External matters such as legal proceedings. All right. So first you have to determine, do you have any of these indicators? That's step number 1. If you do, what is management's plan to mitigate those indicators? Let's go straight to the bad point. If you don't have any good plans to mitigate, there is substantial doubt about your going concern. Okay? Let's talk about the plans to mitigate. They give 4 examples that I'm going to go through. Jump right to. I don't like all of these. One of them that's surprising that they don't have in here is restructuring debt. But they say dispose of assets of a business. And we had a nonprofit client that said, we don't have a going concern issue. We have investments that will help us. It's like, that's good. I think we need to disclose that because we should be telling the reader, oh, by the way, to be able to continue operating, we're going to have to be eating into all our other assets. They weren't too happy when I said that. Borrow money or restructure debt. So they do have that there, but I would like that to be more emphasis. Reduce or delay expenditures. You're still going to have to pay them, though. Increase ownership equity. So those are just some of them. I deal with clients, they say, oh, we're going to run our business better. Oh, so you've been trying to run it bad this whole time, but now you're just going to do better? I mean, that's the obvious of what you should be doing. So you really need to dive into this management. I just had to deal with a going concern paragraph for a client, and we just copied the last year. I'm not going to lie. We copied the last year and gave it to them. They said, this is wrong. And we're like, we know it's wrong. It's your responsibility to tell us what you do. I can't tell you what you're going to do for the business to overcome this situation. So it's managed responsibility. Real quick, disclosure requirements. When substantial doubt has been alleviated, you have to describe the principal or conditions or events that raise substantial doubt. So you have to say what it is. You have to say how management's evaluation of the significance of those conditions or events, and management's plans that alleviated the substantial doubt. Now, real quick, when substantial doubt has not been alleviated, what do you have to disclose? The principal condition or events that created the situation. Okay? Management's evaluation of the significance of those conditions. Notice it's the same. Management's plans that were intended to mitigate the conditions. Before, is management's plans that alleviated. Now it's management's plans that intended. And then include a statement in the footnotes. Remember, this is if the going concern situation continues. Include a statement in the footnotes indicating that there is substantial doubt about the entity's ability to continue as a going concern. We could talk another time about the auditor's responsibilities, but I will say this is extremely contentious. I know these are your financials management, and you're very sensitive to the financial statements, and you're very proud of the financial statements, and you hate when we auditors or accountants say you have to have this in there. The problem is, if there's indicators, if I can see it as a simple QC person, other people can see it. Don't try and hide it and bury it. You should have some sort of disclosure addressing it. If you've alleviated it, we've seen it titled as future operations, continuing operations, something, not the words going concern. If it's a going concern, if it's a going concern situation, it's a going concern situation. Okay, in closing, here's some upcoming accounting and auditing events. On June 20th, learn how to avoid deficiencies in your peer review. On June 26th, get a 2024 FASB and AICPA update. And on July 17th, the Society is holding its annual Governmental Accounting and Auditing Conference. Get info on these events and more at njcpa.org/events. And of course, be sure to join the Society's Accounting and Auditing Standards Interest Group. Sign up for free at njcpa.org/groups. Lastly, keep an eye out for our next episode, which Frank and I will be recording at the NJCPA Convention and Expo. Thank you for watching or listening.